Hi everyone, and welcome back to the channel. When it comes to investment planning, deciding how to allocate your assets might be the single most important decision you'll make. But with so many options, selecting the right investments can feel overwhelming. And how do you combine them into a well-diversified portfolio that balances growth, risk, and any preferences you have, such as sustainability? In this investment series consisting of 4 videos, that's what we're going to try and answer. Taking an approach that's backed by some of the world's leading financial academics, we'll walk you through what you need to know to build a portfolio for your individual needs and objectives. Hi, I'm Jim Smith, Senior Financial Planner here at Pacific Wealth. We specialise in helping new migrants and returning Kiwis navigate the intricacies of cross-border financial planning to help you make the most of your new life in New Zealand. In this second video on our investment allocation series, we're going to look at risk premiums and how you can build investment portfolios to suit the needs of individual investors. We start with a review of one of the most essential investment concepts, the equity risk premium. The equity risk premium is the additional return we expect to receive from investing in shares compared to very safe investments such as a government bond or savings in a bank account. One important thing to know about the premium is that it doesn't show up every year. In fact, it can go missing for long periods of time to the point you wonder if it's ever coming back, but if you look over any long data series, it tends to show up in a big way. Here we show the annual return of the S&P 500 index, which are the 500 largest companies listed in the US. And on the dotted line, the return from the 3-month US Treasury bills, sometimes referred to as just T-bills, which are backed by the US government and one of the safest investments available, so effectively risk-free. The equity risk premium is the extra reward investors earn for taking on the uncertainty of equities, compared to the safety of government T-bills. It is not present every year, otherwise it wouldn't be a risk, and often shows up when you least expect. Using the same data, if you had invested $100 in both the S&P 500 index and the US 3-month T-bills at the start of 1928 to the end of 2024, you would have achieved quite different results. If you had invested in T-bills, you'd have earned a return of 3.3% per annum, and your $100 investment would have grown to $2,361. Whereas if you had invested in the US S&P 500 index, you would have earned a return of 9.9% per annum, and your investment would have grown to $982,818. The difference between the risk-free rate of invested in T-bills and the equity market was 6.6% per annum over this period, which was the compensation for taking on the additional risk of equities. If we are looking at returns over the short term, then T-bills are a good measure for our risk-free rate. But if we are looking at returns over the longer term, we tend to use the yield to maturity from a 10-year government bond. In the US, the difference between invested in the 10-year government bond and the S&P 500 index was 5.4% per annum. To illustrate the concept of the equity risk premium, we've used US data, as it enables us to access a long and reliable data series. However, as the US had a very successful economy and stock market over this period, just taking 5.4% per annum as our expectation of equity risk premium going forward wouldn't be very prudent. A more sensible estimate of the equity risk premium going forward will be somewhere between 4 and 5% per annum. Not quite as high as some historical values, but still a positive and meaningfully large number. As we've already highlighted, when we invest in assets where there's some uncertainty of what we will get back, we usually receive a risk premium for bearing the additional risk. For equities, the risk premium is our equity risk premium and the return we expect to receive above the risk-free rate. If you delve into financial theory, you'll come across something called the capital asset pricing model, or the CAPM for short. The model links together the expected return, the risk-free rate, and the additional return of investing in the stock market above the risk-free rate, which is the equity risk premium, and a term referred to as beta. Beta is used to reflect that some companies are more sensitive to movements in the overall market. Stable companies, such as a utility company whose profits are fairly predictable, might have a beta of less than 1, whereas a company, say like Tesla, may have a beta of greater than 1. If we put some numbers into the formula, let's say the risk-free rate is 4.5%, the equity risk premium is also 4.5%, and investing in the overall market, our beta is 1, our overall expected return comes out as 9%. If you were to provide 2 options to an investor, a return of 4.5% for investing in government bonds or 9% from equities, it looks like investing in shares is a no-brainer. This is because we have so far omitted a term to reflect that shares are much riskier than cash or government bonds. This is referred to as the error term. The error term, or what I like to refer to as Ernie the error term, represents the unpredictable factors that create uncertainty in returns, both positive and negative. For equities, the error term is impossible to avoid and is an example of a systemic risk. In finance, it's only through the exposure to certain systemic risk factors, such as Ernie, that we get the prospect of earning a risk premium. But there are risks that are unsystemic and not rewarded by the market. We will look at these next. Rather than invest in the overall market, how would things be different if we instead invested in a single company? If you think about it, the expected annual return would remain the same, but the risk would increase, as in addition to the overall market, we would be exposed to specific risks of the individual company. The individual company could outperform or underperform the market for a whole host of different reasons, such as bad luck, poor management, or some form of financial irregularity. So investing in a specific company results in a greater variability of outcome, but has no prospect of an additional return premium. This is what is referred to as an unsystemic risk. Unsystemic risks are normally diversifiable, so we shouldn't expect to be rewarded with additional return premium. We're going to refer to these types of unsystemic risks as Bernie. Whilst Ernie is the hero of our story and represents the true source of systemic risk, which comes with an accompanying risk premium, Bernie in many ways is Ernie's arch enemy and represents diversified unsystemic risks which add to the uncertainty of returns but provide no additional return premium. Think of it this way: you want Ernie, but you don't want Bernie. Sorry, Bernie. If you are a rational investor and care about both risk and return, you should normally seek to eliminate as many stock or security-specific risks as possible from your portfolio. Investors can do this through holding many hundreds of different securities across a range of different sectors and geographies. In the last section, we introduced the idea of risk factors and explained the equity risk premium, which is the main risk factor for invested in equity-based investments. We now consider the main risk factors for fixed interest investments, which we also refer to as bonds. Fixed interest investments typically have pre-agreed cash flows and pay a series of regular income payments and then repay the original capital back of the bond at maturity. If you think about it, when you buy a fixed interest bond, you are in fact buying a series of cash flows, which are normally fixed over several years. To value the cash flows, you need to consider the risk associated with the bond issuer and the possibility you won't receive your pre-agreed cash flows, which is the credit risk. You also need to consider changes to interest rates, which can affect the price that other investors would pay for the cash flows at any given times. Term risk can be difficult to understand, but let's imagine you buy a bond and then shortly afterwards interest rates go up. In this example, the value of your bond is likely to fall. The reason your bond falls as interest rates rise is because the general level of interest rates is now higher than before, and you could get a higher return from investing with a different bond. Hence, the value of your cash flows is now worth less than if you were to sell them. If you buy a bond and then interest rates are reduced, the value of your cash flows from the bond should be more valuable. The level of term risk is determined how many years before the bond matures, with longer term bonds being more sensitive to changes in interest rates than shorter term bonds. This sensitivity is measured by something we refer to as duration, which is measured in years. Generally, if the duration is twice as long, then the bond will have twice the sensitivity to changes in interest rates. This relationship can be thought of as being like a seesaw, with duration magnifying the effects of any changes in the bond value. Longer term bonds therefore have a longer duration than shorter term bonds, and for a given change in interest rates will have a larger change in value. Like Ernie, term risk is a systemic risk factor, and we would normally expect to receive an additional return premium from being exposed to this risk. In addition to term risk, we also have credit risk, which, as mentioned earlier, is the chance of default. To help investors evaluate the chance of default, credit rating agencies such as Standard & Poor's, Moody's and Fitch assess the financial strength of companies issuing bonds and give them a credit rating. This helps investors assess the risk of different bond issuers. Based upon the S&P ratings, a AAA bond is the strongest rating, and bonds that have a credit rating of BBB plus and above are generally referred as being of investment grade, whereas bonds with lower credit ratings, such as the BBB bond and below, are sometimes referred to as junk bonds. The chance of default generally increases as the credit rating falls. We can see this from this table, and that a AAA bond has a 1 in 600 chance of default over 5 years, which is a BB bond has a 1 in 10 chance of default over the same time period. In this video, we have explored the 3 main systemic risk factors that should provide an additional return premium. These are the equity risk for shares and term and credit risk for fixed interest bonds. Each asset that we buy and put in our portfolio is likely to have different exposures to these 3 risks, which we can then add up and determine the overall risk at the portfolio level. This helps us to design a portfolio by gaining exposure to the systemic risk that we want as an individual investor, whilst removing the risks that are not likely to be rewarded. In the next video in this series, we show how we can use this knowledge of risk factors and build portfolios to generate long-term returns to meet the needs of individual investors. If you're interested to learn more about financial and retirement planning issues for international migrants moving to New Zealand, we've created other videos that you can explore on our YouTube channel. You can also visit our website, www.pacificwealth.co.nz, and if you have any questions, please feel free to reach out to myself or a member of the team. Thank you for watching, and see you in the next video.